All right, let's get started. Any questions so far on what we've done? All right, let's start building a pro forma balance sheet. It's the next step in our model. Now that we know what our capitalization is going to look like right after the transaction, how much debt, how much equity, we need to integrate that into the pro forma balance sheet and also make some transaction-related adjustments along the way. Okay? This is where the modeling for LBOs, there's not a lot of rocket science to LBO modeling. And this is where the modeling really takes on more of an Excel flavor. We're going to be doing a lot of linking. When we get into the model tab tomorrow, we're going to be doing a lot of inserting rows, inserting columns, changing references, whatnot. There's not really a lot of finance until we get down to calculating that IRR. All right, so there's really a lot more Excel work, so a good chance to practice skills in terms of linking and in terms of the Excel skills. So first thing we need here is we need our historical balance sheet. All right, so what does the balance sheet look like for the company immediately before the transaction? What we're going to do for every line item in this column is we're going to link to our historical balance sheet. That is our 12/31/2008 balance sheet on the model tab. So for cash, I want to say equals. I'm going to control page down to my model, G47. I promised I'd put up some of these shortcuts again as we go. All right, so to navigate between tabs, control page up or page down. And control page up will take you left across the tabs. Control page down will take you to the right. I know a few people weren't here last week, but as we talked about in class, we want to get away from using our mouse. Use the keyboard shortcuts both to navigate and to create our links. All right, so we would not want to say equals, then use our mouse and go down and select the model tab, then use our mouse and go select G47. We want to say equals, control page down, and we want to arrow key over to G47. It saves a lot of time. All right, now what we can do here, because accounts receivable, inventory, other current assets all appear in the same order here, we've done that intentionally, as they do on the historical balance sheet, we can copy that formula for our cash and paste it down below. So if we hit Control C to copy, for copy, shortcut, Control C. If we hit Control C to copy, then Alt E S F, same shortcut as we were using earlier. Hit Enter, F9 to recalc. We get the numbers. We also preserve that underlined formatting in that fourth cell, that cell for other current assets. Now that we have that, right, again, in this case, we cannot use Alt equals for our sum function. Remember, Alt equals, what it does is it'll go up to the last number, the last cell containing a number in the range directly above it, and capture all those items. If we did it in this case, we'd get 2008 as well. We don't want that. So we'll type in equals sum and select the four numbers above that. So equals sum B6 through B9, which should give you 27 million. It kind of brings me to another point on our pro forma balance sheet. And this, maybe it's a matter of personal preference. On all of the subtotals, I like to calculate them here. I could link back to my historical balance sheet. I could link back to the cell where it says 27 million. But if some of my references were off here, then I wouldn't know it. All right, so I like to link to each of the individual line items and then calculate all the subtotals right there in line. It's a way to check and make sure you've linked to all the right numbers and that they do in fact add up to what they should. Right, so that's my total current assets. I'm going to link to gross PP&E. Paste that down to cumulative depreciation using Alt-ESF. So again, I want to preserve that underline. When I hit F9 to recalc, I should have these numbers, 323.2 for my gross PP&E, 45 million for my cumulative depreciation. Now, real important here, don't make the mistake of summing these up. Remember, net PP&E represents the difference between gross PP&E, cumulative depreciation, so we want to say equals B12 minus B13. And you should get 278.2, which matches the historical balance sheet. All I'm doing right now is if you go to the Model tab, I'm basically, at this point, I'm basically replicating the balance sheet that's on my Model tab, the historical balance sheet. That's all I'm doing. And then I will adjust that balance sheet for the transaction. So when I've done this correctly, my historical balance sheet column will look exactly like it does here. All the numbers will match. Amortizable intangibles equals G57 on the Model tab. And that's actually blue. It shouldn't be. It should be black. So once you get that link set up, change the color to black. That should be a link, not a hard code. Right, so the reference is G57 on the Model tab, and change it to black. Change the font color to black. And then same thing as we did above, Alt-ESF. That is Control-C to copy. We'll paste that into the goodwill cell using Alt-ESF to paste. So you'll get 0 for amortizables, 5 million for historical goodwill. Remember to hit F9 too. Make sure you've recalculated everything. Then total assets, we're going to say equals total current assets plus sum. And I just want to sum the items from net PP&E all the way through goodwill. So equals B10 plus sum, left parenthesis, B14 through B17. I'll leave that formula up, but you should get a result of 310.2 million. Right. This matches exactly, it should match exactly what our historical balance sheet says. We're going to now do basically the same thing for our liabilities and equity side of the balance sheet. So for accounts payable equals, control page down twice, G62 on the Model tab. I'm going to copy and paste that using Alt-ESF. And then sum my current liabilities using Alt equals. All right, so I created a link for my accounts payable. Then I copied that. I used a paste special to paste that into the cells for accrued liabilities and other current liabilities. And I used that paste special formulas, so I would preserve the underline here. And then for total current liabilities, I used Alt equals to sum all those items above it. If you do it right, you should get 13.4 million for total current liabilities. Does everyone have that? Now as we scroll down, here's where the balance sheet starts to take on a little bit of a different look structurally than our historical balance sheet. Here in the Pro Forma Balance Sheet tab, we're distinguishing between our existing debt, that is the old debt of the company before it's bought out, and the new debt that's going to be borrowed in connection with funding the transaction. All right. So if we're going to make those, we've added these rows because we're going to need to make adjustments in our adjustments column relative to the new debt. If there are no rows to accommodate those, we can't do it. All right, so we've added those rows. What we'll do a little later, and I think we actually may get to it today, is when we go and drop this into our Model tab, we're going to have to make room in our Model tab to accommodate those as well. You'll, I think, understand more of that when we get there. But for right now, recognize that we have an existing debt section for the old debt that's going to get paid off. We have a new debt section for the new debt that we're borrowing. Does that make sense so far? Okay. For existing debt, just like we've done so far, we're going to take that from the from the Model tab. Our revolver, we're going to say G67. And you can use a fill down command to paste that down. All right, remember, there are two different fill commands that we've used. And it's just like a copy-paste, but it's an extreme short form of that. All right, so if we wanted to fill something to the right, like we did often last week, it's Control-R. To fill something down, we used Control-D. All right, and for those of you who weren't here last week, I'll show you that again. My revolving credit facility, the first thing I did was link to my historical balance sheet. So I said equals G67 on the Model tab. Now there are a few ways I can copy that down. I can do a copy, Control-C here, and then Control-V to paste, F9 to recalc. Straightforward, copy, paste. Or I can use what we call a fill command, where I can just fill this formula down as far as I want. If you use a fill command, it'll just fill it in every cell below there where you specify, or if you use a fill right command, it will put that same formula into every cell to the right. Fill down command, I need to select, first of all, the cell that I'm copying, hold down Shift, and then select my destination range. In this case, the term loan and the unsecured debt. I should have all three of those cells highlighted. Then you can just hit Control-D, F9 to recalc. Okay, now we come to our new debt, and right now, remember, this is a split second before the transaction gets done. The new debt doesn't exist yet. It hasn't been borrowed. For our new debt, we're just going to enter zeros. We're going to hard code them. And then other liabilities, we're going to link to our historical balance sheet equals G70. We want to pick up that $2 million of other liabilities. Okay, and then total liabilities, we're just going to take the sum of everything from total current liabilities through other liabilities. We're just going to sum up all of our liabilities, basically. Make sure you start with B24, total current liabilities. Don't start with accounts payable, because you'll include total current liabilities. You'll be double counting. And so your formula should be equal sum B24 through B37, and you should get $206.2 million as your subtotal for that. And lastly, shareholders' equity. We'll just link to the historical balance sheet. For retained earnings, we'll say equals G74 from the Model tab. Control-C to copy, Alt-ESF to paste for common stock. F9 to recalc. You should have retained earnings of $94 million, common stock of $10 million. And our total shareholders' equity, we can do an Alt equals to sum. $104 million. Total liabilities and equity is just what it says. Equals B38 plus B43. And you should get 310.2. 310.2 should match our total assets, and it does. All right, so the balance sheet's in balance, cardinal rule of accounting. Remember what we said last week, we oftentimes put in this check figure just to make sure we're in balance. And here you can calculate it two ways, either total assets minus total liabilities and equity, or the reverse. Either way, we want to measure the difference between the left side and the right side of our balance sheet. So here I said equals B45 minus B18. But it'd be the same thing as saying equals B18 minus B45. Take the difference between those two, and if it's zero, it means we're in balance. Our check figure zeroes out, we're in balance. All right, so step one is complete. We've got our historical balance sheet entered. Next thing we need to do is we need to account for all the transaction and financing adjustments that we're going to have in conjunction with the deal. And in some cases, in some deals, you'll see some adjustments, some purchase price adjustments relative to the working capital. That is, the accountants go in, they say, okay, well, the value of the inventory is X as opposed to what's on the balance sheet, so we're going to make an adjustment there. Or we're going to write up the fixed assets to their fair value in some cases. Here, we're not going to assume any adjustments to the working capital of the fixed assets. We're really going to focus more on adjustments relative to our capitalization, our debt, our equity, adjustments relative to goodwill, adjustments relative to intangibles. All right, so for our current asset adjustments, these will all be 0. And just hard code those in. And then for our subtotal here, total current assets, now we can actually just copy and paste the formula that we have over in our historical column. So it's going to be the same subtotal. We're going to add cash, AR, inventory, and other current assets. So just Control-C to copy, Control-V to paste, F9 to recalc. Gross PP&E, cumulative depreciation, we're not going to make any adjustments to that. Again, in the real world, the accountants might write these up to their fair value. We're just trying to keep it simple here. And we can copy the formula for net PP&E as well. Control-C to copy, Control-V to paste. You would not want to use a fill command here, because if you look closely, we've got that very narrow cell right between. And if you used a fill command, you'd get some content in here, and it would probably show up as a number sign, because it wouldn't be able to fit. But you'd see something there when you don't want to. All right, so you don't want to use a fill command there. Next thing we need to do is we need to account for some amortizable intangibles. We also need to calculate what our goodwill is going to be. We haven't done either of those yet. Right? There's nowhere right now that we can link to. So what we're going to do, if you scroll down to the bottom of our worksheet, I'm going to put in some footnotes where we calculate these numbers, and then we're going to link to these up above. Right, so the first thing we're going to do is we're going to calculate our goodwill. Remember, we touched on the notion of goodwill. Goodwill represents the difference between the market value of the equity when it's bought out and the book value at the time of purchase. Right? The excess, and usually it is an excess, represents what we call goodwill. That gets booked onto the balance sheet and stays on the balance sheet as long as the accountants don't come in at some point and determine that it's been impaired. Remember, you used to be able to amortize goodwill. That went away probably about 7 years ago. You no longer can, but it gets tested annually for impairment. All right, goodwill, again, difference between market value of equity and book value. So what we want to do for equity purchase price, we want to link back to our sources and uses tab, equals B11, that $169.2 million equity purchase price. Next thing we need is book value of equity, which is basically total shareholders' equity from the balance sheet. But instead of just linking to that, the one thing I want to do, this says less book value of equity, so I want this to be reflected as a negative. So instead of saying equals, what I want to say is minus B43. And once we have these two numbers, 169.2 for the equity purchase price, minus 104 for the book value of equity, we can just add those up. And it should give you goodwill, new goodwill, of $65.2 million associated with this transaction. So we're going to link to that in a moment up above. And then the other item we're linking to from above is amortizable intangibles. It used to be, until last December or so, until December of 2008, that all transaction-related fees could be capitalized, they could be booked on the balance sheet and amortized over time. Now, the Accounting Standards Board has ruled that only financing fees can be actually booked as an asset, as an intangible on the balance sheet and amortized over time. Any other deal fees, and that's going to come into play in a minute, so our investment banking fees, our legal fees, or other costs, any other deal fees like those need to be expensed, either in the time period leading up to closing as they're incurred or at closing. All right. So of our $14 million in fees, the financing fees can be capitalized, the others need to be expensed. All right. So for our financing fees, I want to say equals. We're going to link to our source and use to B as in boy 18, 8 million. And then we'll link to that again, cell B60. You can either do a quick alt equals. It's really not a sum of one number, but our new intangible assets, 8 million.
Sorry, financing fees is 8 million, right?
Right.
And then the new intangible assets as well?
You can say either equals B59, or you can say alt equals. It's just the same number. So for my amortizable intangibles, I'm going to say equals B as in boy 60. For my goodwill, I'm going to say B 54. So in other words, we're capitalizing 8 million of fees, we're creating another 65.2 million of goodwill. So at the end of the day, when we add up our original goodwill plus our new goodwill, we'll have a little over 70 million of goodwill on our pro forma balance sheet. Now for total assets, we can copy and paste. And you should get total adjustments to our assets of 73.2 million. So we've made 73.2 million of positive adjustments to the asset side of our balance sheet. What's that tell you on the liabilities and equity side? Well, we're going to make how much in adjustments to the right side of the balance sheet? 73.2. Balance sheet always has to balance. So we're going to make the same amount of adjustments overall down here as we made up here. Let's move on to the liability side. Just as with our working capital assets, we're making no adjustments to our working capital liabilities. So for AP, accrued liabilities, other current liabilities, those are each 0 in the adjustments column. And then sum those up for total current liabilities. We want that to be alt equals for sum, or you can copy and paste from the historical balance sheet, either way. And now we'll move on to examine our existing debt. What did we say about the old debt of the company? What happens to it in the transaction? It gets refinanced. It gets paid off. All right, so for each of these items, it goes away. So for each of these items, we want to say minus, in the case of the revolver, for example, minus B27. You can use a fill down command. The goal here is when we add column B to column D, the result in column F, our pro forma balance sheet, will be that the old debt or the existing debt is zeroed out. Let's do the new debt. All right. The new debt, remember, we're borrowing in connection with the transaction. We're borrowing so we can fund the deal. So what we're going to do for each line item, we're going to refer back to our source and use table to pick up the opening balance from our capitalization. So for revolving credit, equals control page up, F17. And then you can use a fill down to pick up the balance for the term loans, senior bonds, and unsecured notes. So control D to fill down, F9 to recalc, and you should get 0 for the revolver, 120 for the term loan, 90 for the senior bonds, 60 for the unsecured debt. All right, and no changes to our other liabilities, so 0 for that. And you can copy and paste the formula for total liabilities over into this column, into the adjustments column. And so far, our pro forma balance sheet adjustments should reflect 79.2 to the total liabilities. And then the last adjustments we need to make are going to be to our shareholders' equity section. Before we do that, before we make any adjustments to retained earnings, I want you to scroll down a little further in your model to the very bottom where you see transaction fees excluding financing fees. Remember what I said a moment ago. FASB recently ruled we can only capitalize financing fees. All the other fees need to be expensed at closing. The way we're going to expense these, we've talked to a few accountants and they told us this is the best way to do it here for teaching purposes. We're going to expense these through retained earnings. So in other words, we're going to buy out the old retained earnings of the company. We're also going to expense the other $6 million of transaction fees that we were not able to capitalize. In other words, we're going to actually have a deficit net worth at closing equal to the amount of these fees. Does that make sense? Okay, we'll see that in a minute. For now, let's just link up so we can capture the amount of these fees. And just like we did for financing fees for banking, we're going to say equals B19 on the source and use. And we can copy Alt ESF to paste. Should get $4 million for investment banking fees, $1 million each for legal and other fees and expenses. When we sum those items up, obviously we get $6 million. And we're going to link to this in a moment when we expense these through retained earnings. All right. Let's go back up to retained earnings. And remember what happens before we deal with the fees. Remember what happens to the existing equity of the company. It's kind of like the old debt. We're buying out the old equity holders. So these items first need to go away. First thing we would need to do for the retained earnings, we want to say minus B41. We've bought out the old retained earnings. Now we need to expense those fees. So we'll also say minus B68. So you should get a total adjustment of negative 100 million. So if we add the old retained earnings of 94, subtract 100 million, like I said before, we'll have an opening deficit net worth of 6 million. Okay, same thing with the old common stock. We want to subtract that, it's going away. But remember, there's also another transaction that's occurring in the common stock. We're putting equity into the company. So we want to subtract the old common stock, but we also want to add the sponsor equity. Just like we added all these new pieces of debt to the new debt section, we need to account for the equity that we're injecting into the company. We need to add that 104 million. All right, so the total adjustment on the common stock line should be a positive 94. Then the total adjustments to our shareholders' equity, we can sum those up. Total adjustments are minus 6. And then we can copy the formula for total liabilities and equity from the historical column, copy it to our adjustments column. And just like we said earlier, when you copy and paste it, hit F9 to recalc, we will have made 73.2 million of positive adjustments to the total liabilities and equity side, and our check figure should be 0. Basically, the balance sheet gets bigger, gets larger by 73.2 million as a result of the deal. Now the last thing we need to do for each line item is we need to add the historical column to whatever adjustments we've made to get our opening balance. Right, that is, what does the balance sheet look like immediately after the transaction has occurred? So for each line item, we can take the sum of, well, for cash anyway, the sum of B6 through D6. We're just adding those up. Copy, paste special formulas, and then you can copy your subtotal for current assets, paste that, also using a paste special formula. We want to preserve the borders, we want to preserve the underlines, want to preserve all the formatting that we have in this column already. Otherwise, we're going to have to go back and reformat it. So all your pastes should be paste special formulas, Alt-ESF. And we're just going to work our way down. We're going to do that same thing for every line item. And again, I do like to calculate the subtotals right there in line. Just make sure I've got all the right numbers. Just kind of another check that I like to build into the model. When you get down to your total assets line, it should be 383.4. Once you've got that done, it's a good time to save. We're actually running a little bit ahead of time, so what we're going to do is we're actually going to drop the pro forma balance sheet. We're going to integrate it into our model tab, and we'll stop at that point and then pick up from there tomorrow. For all intents and purposes, going forward, the historical balance sheet of the company basically now worthless. All right, so when we look at the old historical balance sheet, we look at their debt, their equity, remember those items are gone. It's old revolver, old term loan, old unsecured debt, old retained earnings, old common stock, gone. Okay, and in the real world, there might be some additional purchase price adjustments that affect the working capital or the fixed assets of the company. So going forward, especially where it relates to the cash flow, where we're keying off changes in the balance sheet accounts, all those changes need to be driven off of the pro forma balance sheet, not the historical. Right, for that reason, what we're going to do is drop the new balance sheet into our model and then move forward keying off of that. And that'll make more sense in a moment if it doesn't already. But first thing I want to do here on my model tab is if you go to column H, you can put your cursor in any cell within column H. The first thing I want to do is insert a column. I need to first make space for my pro forma balance sheet. We do that by inserting a column, Alt-IC. And now you should have a blank or an empty column in row H. All right, so insert column, Alt-IC. Remember, we can also insert a row using Alt-IR. We're going to do that in a moment. All right, so if you don't already have these in your notes, make sure you get them because they are valuable. Now this column, again, I mentioned we made space for the pro forma balance sheet. The pro forma balance sheet is the only thing we're going to put in this column. Remember, balance sheet represents a moment in time. It's a snapshot. It's that split second where the transaction has closed, but there is no such thing really as a pro forma. We're not adjusting the old income statement. We're not adjusting the old cash flow. We're not adjusting the old debt schedule. The only thing we're going to house in this column is our pro forma balance sheet. And we'll deal with that in a minute. The first thing I want to do, before I do anything else, I want to copy all the formatting in column G. And if you want to quickly select column G, you can actually left arrow, go up to where it says G, left arrow key once on that, or left click, whatever you want to call it. You should be able to select that entire column. Control C to copy. Now go over to column H in that first cell. I want to use the paste special formats command. Different than paste special formulas that we've been using. Paste special formats, Alt-E-S-T as in Thomas. And this will paste only the formats in column G. You hit enter. Now what you should see is a nice dotted line going down the right side of column H. That's mainly what I wanted to capture here. And we do that, we put the dotted line on either side of that column really to set it apart from the rest of the model and show the reader that it's where we're going to house our pro forma balance sheet. Right, now what I want to do here is I also want to label this new column so there's no question in the reader's mind or the client's mind as to what's in this column. First thing I want to do is go to cell H4. I want to type in pro forma. And then in H5, I'm going to type in 2008 PF for pro forma. Just make it overly clear what this is going to represent. And you'll see this not just in LBOs, but also in M&A. When company acquires another, there'll be a combined balance sheet post-closing, pro forma balance sheet that gets dropped into a model. We'll see that next week when we start talking a little bit about M&A. I'll introduce, we're not going to do one in class, but I'll introduce the concept of a full merger model, and I'll show you where a pro forma balance sheet would go. But my point is, you'd have this in LBOs, you'd have it in M&A. Right, well, again, this column, again, is only going to house the pro forma balance sheet. To make it overly clear to the reader that that's the only thing that's supposed to be here, I'm going to actually black out all of the cells in my income statement, all of the cells in my cash flow, all of the cells in the debt schedule, just so they know there's not supposed to be anything there. It's kind of like if you've ever read legal documents, you'll see a blank page and it'll say this page intentionally left blank. It's kind of the same idea here. We're leaving the income statement blank. There's no such thing as a pro forma income statement. Okay, so what I did was I selected the entire income statement. To select multiple cells, hold down Shift, use your down arrow key, all the way down to the end of the income statement. And you can use that little paint can. It's the one time I'll let people use their mouse. There is a way to do that with keystrokes, but it's actually, I think, even quicker if you do the mouse in this case. All right, so select that little paint can icon, select black, and your income statement should be blacked out. I want you to scroll past your balance sheet. Leave your balance sheet alone for right now. Go down to your cash flow. Select all the cells in your cash flow, all the cells in your debt schedule. And now, because the last command that we used was to fill those cells with black, you can redo that command by using the shortcut Control-Y. Control-Y will redo the last command you did. Control-Y. And if ever you need to undo something you just did, remember that one is Control-Z. That works. I think both of these work in Word, PowerPoint, Excel, all of the Office programs. Once we've done that, now what we can do is start working on our balance sheet. Before I start linking, because that's what I'm going to do, is ultimately I'm going to be linking back to the pro forma balance sheet I just created. But before I do that, I need to take a look at the structure of my balance sheet here. I need to make some changes. All right, remember, we touched on it a moment ago. If you look at your pro forma balance sheet, you've got your existing debt in one section, and you've got new debt in another. But on our model tab, we don't have that distinction yet. All right, so the first thing we need to do is set up the rows of our balance sheet in the model tab to match the formatting or the structure in our pro forma balance sheet. We're going to do this by inserting a number of rows. So the first thing I want to do, if you highlight any cell on line 67, and I've just highlighted revolving credit facility in cell A67, or put my cursor there, I want to insert a row, Alt-IR. And what I'm going to do is, just as we had done in our pro forma balance sheet, I want to title that existing debt. And actually, if you go to your pro forma balance sheet, cell A26, you can copy that cell. Save you the time of having to type existing debt and then format it within italics. Copy, Control-C to copy. Go back to your model tab, Control-V to paste. Existing debt. That's what you should have in cell A67. Or if you want, type it in and italicize it. Italicize using the keyboard shortcut Control-I. Next thing I need to insert some rows for my new debt. because at the end of the exercise, this needs to look exactly like my pro forma balance sheet. Go down and highlight the row or put your cursor in any cell in row 71, other liabilities. And I want you to hit Shift, hold down Shift, and use your down arrow key 6 times. We've selected basically 7 rows. And now when we use Alt-IR, we can insert 7 rows at a time. And I know that we need 7 rows because I've done the model many times. So your model now should look like this. You should have a number of blank rows between unsecured debt and other liabilities. If we go back to our pro forma balance sheet tab, we can copy the cell where it says new debt. Control C to copy. Paste that into cell A72 on the model tab. New debt. And actually we can copy these 4 cells from the pro forma balance sheet as well. Cells A32 through A35, the revolving credit facility, term loans, senior bonds, unsecured debt. We can copy this text. Save us the trouble of having to type it. So Control C to copy. Paste those right below the cell where it says new debt. And then you can left indent those or basically move those to the left. You can use that little icon up here at the top. Or you can use Control Alt Shift Tab. Decrease your indent, Control Alt Shift Tab. All right, that was the goal, to set up this balance sheet so it mimics the formatting and the structure of the pro forma balance sheet. Now that we have that, we can actually link back to it and get the proper values into our pro forma column. That makes sense? So what I'm going to do is I'm going to go up to cash in the pro forma column and I'm going to start linking. Equals F6 for my pro forma balance sheet tab. And I can start copying, pasting using Alt-ESF. Again, I'm going to calculate the subtotals right here. All the linking back and forth, moving numbers back and forth, it's helpful to calculate the subtotals right in line. Helps you avoid making a mistake. If you link something wrong, and then you subtotal it, you'll catch it. You should be able to catch it right away. Same for gross PP&E, net PP&E. Remember, for the subtotal, take the difference. Do not add them. You can also copy the subtotal formulas from column G and paste those into column H using an Alt-ESF. Paste special formulas. Whatever's easiest for you. Do that for the liability side. And just work your way down the balance sheet. So at this point, you should have your pro forma balance sheet integrated into the model, onto the model tab. The numbers should match what we had on the pro forma balance sheet tab. The balance sheet should balance. And again, starting tomorrow, what I'm going to do is we're going to work straight down top of the income statement all the way through the bottom of the debt schedule. We're going to adjust for everything related to this transaction. All right, so we've got some new amortizable intangibles. Those need to be amortized. All right, we've got some new goodwill. We need to make sure that our balance sheet going forward reflects the new goodwill as well as the old. Different pieces of debt, so we're going to modify our debt schedule. Cash flow needs to key off the pro forma balance sheet, not the historical, and so on. All right, so we're going to make a lot of those adjustments, make changes to the links. At the end of the day, we're going to have, just as we did last week, we're going to have a working financial model, but this one will reflect the increased or the change in the capital structure of the company, and then we'll do the returns analysis. All right, so that'll be tomorrow. Before we get into that, I want to introduce the homework because you now have enough information where you can do basically to this point. We've taught you enough so you can create a pro forma balance sheet and drop it into a financial model. All right, but what I want to show you is in the homework. If you go into the homework subfolder, open up your Company B homework shell model, and if you open up There's another Excel file called Company B Instructions. You'll see an instructions page very similar to what we've handed out and what we've used today. This is basically your roadmap for doing this model. A few different assumptions. Overall, the methodology is the same. We're taking an existing financial model, we're modifying it as though we're a private equity fund looking to buy out the company. All right, so if you follow these instructions, you should be fine. The one thing I want to point out is on the Pro Forma Balance Sheet tab, it's formatted a little differently than what we've just seen. Okay, not to say what we just did is wrong or it doesn't get done in the real world. There are a couple different ways a Pro Forma Balance Sheet can be set up. And this is the homework. Pro Forma Balance Sheet is basically the other way of doing it. All right, and what we're assuming here implicitly is rather than the buyer buying the company and refinancing the debt, we're assuming the seller is going to refinance the debt prior to the transaction. All right, so the seller's going to come in, they're going to take out the debt, they're going to wipe it clean. It's probably going to involve an equity infusion in order to do that. And we're going to buy, as the private equity firm, we're going to buy a quote-unquote clean balance sheet. That is a balance sheet with no debt. All right, so that's really the only difference here, or one of two differences. All right, so here we're going to take the historical balance sheet as we did in our model today, the adjustments by the seller pre-transaction. Basically, you're going to have, as I just mentioned a moment ago, the seller's going to wipe away the debt, and there's going to be an offsetting equity adjustment, basically an infusion of equity that needs to happen in order to keep the balance sheet in balance. When you add those two columns together, you'll get pro forma before the deal, before the new financing. And then you're just going to create your financing and your transaction adjustments exactly as we did today. We're just going to show them in different columns. All right, so we'll have financing assumptions in one column, we'll have transaction adjustments in the other. These basically will, when you total them up, they will exactly offset one another. And you can see this if you want to even look ahead, look at the solution, you'll see what I mean there. But these will exactly offset each other so that when we add our pro forma before new financing plus our financing adjustments plus our transaction adjustments, we'll still have a balance sheet that balances. All right, so that's really all I wanted to talk about with respect to the homework. It's a little different presentation of the pro forma balance sheet. I didn't want people to see it and get freaked out. All right, and if you have any questions, again, we've given you the solution so you can kind of look through it. It's very self-explanatory once you see the solution. So if you've got time tonight, you want to get a jump on the homework, I would basically do your transaction assumptions, your sources, your uses, your pro forma balance sheet. You can drop that into the model just like we did today into this column I. And then I'd stop there. Then tomorrow, after we've shown you how to make all the other adjustments, then you can pick up and finish your own homework model. All right, well, let's talk. We do have a few extra minutes. Let's talk about waterfalls because someone mentioned that to me. Someone always mentions that to me in class, and I like to make sure I kind of explain that to really give people a sense kind of for how private equity works. All right. It's really not part of the class, but it's something that I've seen a lot of. It's kind of the same whether it's private equity or real estate private equity. I've got some examples of some real estate private equity waterfalls if you want to see them. You can get those, I'll email those to you. So just send me a reminder, I'll email those to you and you can see how it works from an Excel standpoint. But basically, what is a waterfall? Can anybody tell me? So a private equity fund is typically set up as a limited partnership. Okay, so if we're Blackstone, let's make the assumption for a moment that we're Blackstone. We're all partners of Blackstone. We raise a fund. We would represent the general partner to the fund. Okay, general partner of, let's say, Blackstone LP. All right, we'd put in 5, maybe 10% of the overall equity. Let's call this $1 billion fund. Maybe we'd put in $100 million of our own money. We should be so lucky, right? We'd put in 5 or 10%. We would raise the remainder of that from limited partners. pension funds, hedge funds, funds of funds, endowments, high net worth individuals. All right, so actually let's, if this is a $100 million fund, let's say we put in 10, let's say our LPs put in 90 million. Okay, so the LPs put in the majority, we put in a sometimes called sliver equity piece. But we're going to be responsible for the day-to-day management of the fund. We're going to be responsible for identifying deals. We're going to be responsible for managing our portfolio investments. We're going to be responsible as the GP for finding exits. Basically, we're the ones in charge of running these deals, running the fund, and hopefully bringing back a nice return to our limited partners. All right, so that's how a fund is structured. And a waterfall basically dictates at the end of the day, let's say we sell an investment. All right, let's say we go in, we buy this company A that we've been modeling. After 5 years, we sell it. And let's say we have $100 million of cash to distribute. The waterfall dictates how that cash is going to get distributed between us, the GP, and all of our limited partners. Make sense? And a waterfall, let's do a real kind of a plain vanilla waterfall. Another way of thinking of it is priority of payments. All right, so when we get cash in, what happens first? And a lot of times what happens first is we pay a preferred return of some percentage that gets accrued over time on the initial investment or the contributed or committed capital, the invested capital to the deal. All right, so let's say it's a preferred return of 8% per year. Usually this is applicable both to the LPs and the GPs. So we're all earning preferred return of 8% per year on our money. So if we fully invest our $100 million fund, at the end of year one, we should have a capital account balance of $108 million. All right, so the first returns go to satisfy our pref. After the preferred return has been satisfied, usually what happens is initial investment gets returned, return of capital. So that initial $100 million that we've put into the deal or we've invested gets returned. And so say we have, let's say, $200 million at the end of year one. The first $8 million of that goes to paying preferred. The next 100 goes to paying return of capital. And now we've got $92 million left to distribute. Make sense so far? Pretty basic. All right, the third thing that might happen is we might have what we call a look back. Right? We're going to return capital. We're going to pay returns to our LPs. Let's say we're going to distribute cash 90-10, 90% to the LPs, 10% to the GPs, 90% in favor of our LPs until their IRR equals, let's say, 15%. Right, until we get to our hurdle rate, until the LP has achieved an IRR of 150 or 15% on their money, including the pref, but their cumulative returns reflect an IRR of 15%. And then once we get over that, then as the GP, as the general partner in the fund, we start getting what's called carried interest, or carry, or promote, as it's sometimes called. And maybe then it's, 75-25 to LPs. So the GP, what happens, GP, remember we put in 10% of the money? Once we get over that 15% hurdle, now we can get 25% of the remaining cash, even though we only put up 10% of the money. Or maybe this goes, maybe it's an aggressive, maybe it's a really generous waterfall where it goes 50-50. We put up 10%, but once we achieve our hurdle, we can start taking 50% after that. All right. So these items that I've circled are what we would call the carried interest. And a waterfall model in Excel basically looks at all of the returns to each class of investor, LPs, GPs, over time, and in each case determines, has this been met? If this has been met, then go on to this. Have each of these been met? If they've been met, then go on to this. Have our returns exceeded 15%? If they have, then go here. A lot of if-then statements, a lot of what we call nested if-then statements, if statement within an if statement, and can be pretty tricky, especially if you get to numerous levels of waterfall. Maybe it's 5 or 6 or 7 different levels. Maybe there are a few different look-backs. Right? The look-back being the measurement of that, have we achieved the 15%? All right, so that's sort of generally, and that's not the common structure. That's just a simple structure of how a private equity fund might be structured. Blackstone may have a more sophisticated structure than that. There can be what's called catch-up provisions, where after, say, return of capital, maybe then the GP gets to catch up. Maybe they'll get a disproportionate amount of the distributable cash until they've caught up in terms of the percentage of overall cash distributions, or into an absolute dollar amount or something like that. All right, well, that's all for today. Again, we're going to start tomorrow working at the top of our model and going down.